Welcome back, everybody. This is Trading Learning 101. Today we are going to get in the history of candlestick charts, and I am going to show you a few of candlesticks. So if you're a beginner and know nothing about candlesticks, this is going to be a great video for you. Now let's jump into it. If you don't know nothing about candlesticks and you're using, for instance, Robinhood, where they use just line charts, you're missing out on so much information. When you learn candlesticks, it will take your trading and how you see the market and doing technical analysis to a whole new level. And if you're just using a line chart, let's look up a line chart. You don't really get too much information from something like that at all. So this is your basic candle right here. Now, the only difference is between a green candle or a white candle, which is bullish, and a bearish candle, which is normally red or black. With a bullish candle, you have the open at the bottom, and then it has a lower wick here. This is the low of the day, or the low of the candle. And then as price moves up, the candle will be green. On a green candle, which is bullish, it closes at the top. This long wick right here would be the high of this candle. You can use these candles on the intraday chart, 1 minute, 5 minute, 10 minute, 30 minute, 1 hour, and on the daily chart. So on the intraday, 1 minute would be this candle. This gives you so much information on 1 minute. It gives you the low of that 1 minute, it gives you the open, it gives you the close, and it gives you the high of that one single minute. And same thing on the daily chart. One candle is the whole price action of that day. It would open at the bottom. The wick, if it would have one, would be the low of the day. It closed the day right here. So price moves up and fills this candle green and closes right here. This long wick right here would be the high of the day. So price came up, it touched, and it came right back down and it closed. Or it could have came back down and closed. That's when you have to look into the intraday chart to see what the price action did from this green area right here. Now a bearish candle, it's like the same thing as a bullish candle, but everything, just the open and the close is opposite. That's the only thing. So the open on a bearish red candle is at the top, and as price moves down, it turns this red, and price closes at the bottom right here. So price opens at the top, it could come up, and this wick here would be the high of that candle, comes back down, crosses below the open here, turns this red, and it starts to move down and down and down, and it moves down and down and down, and then price starts to bounce and move back up. This wick right here would be the low of this candle, moves up, and it closes right here. And the same thing, you can use these on the intraday charts and the daily charts. And what's so great about these is you can use these candlesticks with indicators like the Fibonacci, moving averages, the MACD, Elliott wave. They work perfect with all these tools and indicators that you have. So going from that, let's get into it. This is a website right here, www.stockstradinginforcent.com. I'll leave a link for it for you guys down below. This is a really helpful website if you want to learn more about the history. We are going to go through and read this article and just get into the history of the candlesticks and know where it comes from. It's good to know the history on all this stuff and learn facts about it, because you're going to be using it. And then also one more thing, I'm just going to throw out to you guys a few books that I highly recommend that everybody check out and read. These are must-read books for candlesticks. Right off the rip, I do not own the copyright to these images. I am just showing you these images to show you what they look like, okay? So please don't hit me with copyright. The first book I'm going to show you is by Steve Nissen, and that is the Japanese Candlestick Charting Techniques. I absolutely love this book here. I bought a copy of it. It is by far my favorite trading book. This is jammed packed with information for you guys about the history of candlesticks, how they work, how to make patterns or see patterns, and he gives great examples on how these work. I highly, highly recommend this book. The next book that he came out with is Beyond Candlesticks, and these are all by Steve Nissen. If you don't know who Steve Nissen is, he is the candlestick man. He's the one that presented candlesticks to the public pretty much and made it popular for traders to use candlesticks. I want to say candlesticks really got popular in like the early 90s to the mid 90s. That's when a lot of people started switching over from line charts to candlestick charts. So Beyond Candlesticks, this is a more in-depth book. He goes into gap plays and other charting techniques. I really enjoyed this one too. And then the third one here is just a crash course. What's really cool about this one is it combines the first and second book all into one book. And then what's really cool about this is it also quizzes you. So after every section or after every chapter, it quizzes you on what you just read. And then I believe all the answers are in the back of the books. I own all three of these books, and I would highly recommend these are a must-have for anybody that's interested in trading in the stock market. Now back to the story here. So the history of Japanese candlesticks. What is the history of Japanese candlesticks charting? This is an ancient Japanese method of technical analysis used in trading rice in 1600s. It was used in trading rice contracts from 1710 onwards. So candlesticks are called Japanese candlesticks or simply Japanese candle. The history of candlestick charting dates back to the 16th century. It was developed by Japanese traders in 1600s to trade rice contracts. Until about 1710, only physical rice was being traded. Later, a futures market emerged where coupons were issued, which were records of promise of delivery of rice at a future time. This is the beginning of futures trading. How did the first futures trade started? The area of Japan was ruled by a group of daimyo, feudal lords of the 15th century. Being small rulers, they continuously had internal war among them. Finally, General Takawaga, I'm sorry if I'm saying these wrong. I do not know. I'm trying, guys. So finally, General Takawaga Lasaya, who ruled from Edo, won the famous Battle of Sekigahara in 1600. This victory gave birth to the present unified Japan. To be in power, General Takawaga had to keep all the feudal lords under his control. He cleverly made all the lords to live in the city of Edo with their family, when even they have to go to their respective provinces. they have to leave their families at Edo. This stopped them from conspiracy because their family were indirectly kept as hostage. The main source of income of federal lords was by taxation. The farmers were paying the tax in the form of rice, which they were growing in the fields. Since the rice could not be transported from the daimyo's province all the way to Edo, they set up warehouses in the port city of Osaka to store their rice. Back in Edo, the daimyos were living with an expensive lifestyle. In competition with each other, to maintain their lifestyle, they had to not only sell the rice they had stored in warehouses at Osaka, but also sell the rice from future harvests. Warehouse would issue receipts or coupons for the future rice. These were called empty rice contracts. Since the rice was not in anyone's physical possession and they were sold in the secondary market, this was the beginning of one of the world's first future markets. Trading in rice futures needed much speculation, and it was from the speculation that Japanese technical analysis was born. Who was Homo Munasha? At this junction, Homo Manhashia, or 1724 to 1803. A rice trader from Sakata, Japan organized this ancient wisdom, developed and used Japanese candlestick charting very successfully. He traded rice contracts in the Ojima rice market in Osaka during the Tokugawa shogunate, also known as the Tokugawa Bakufu, a feudal regime of Japan established by the Tokugawa Ieyasu and ruled by the shoguns of the Tokugawa family. This period is known as the Edo period, and it gets this name from the capital city Edo, which is now called Tokyo. This time is also called the Tokugawa period of pre-modern. Homo Munasha is often referred as the father of the Japanese candlestick charting. His trading success reputedly led to him becoming an honorary samurai. His methods are the oldest example of technical analysis documented. Stories claim that Hama established a personal network of men about every 6 kilometers between Sakata and Osaka, a distance of some 600 kilometers, to communicate market prices. He discovered that although there was a link between the supply and demand of rice, the markets were also strongly influenced by the emotions of traders. Because of this, there were times when the market perceived a harvest as different from the actual. He reasoned that studying the emotions of the market could help in predicting prices. In other words, he understood that there was a difference between the value and the price of rice. The difference between price and value is as valid today with stocks, bonds, and currencies as it was with rice centuries ago. In 1755, he wrote San an Kinsen Hiraku, the Fountain of Gold, the Three-Monkey Record of Money, which is the first book on market psychology. In this, he claims that the psychology aspect of the market is critical to trading success, as that traders' emotions have a significant influence on the rice prices. He notes that this can be used to position oneself against the market. We're almost there, guys. In this, the author states that after 60 years of working day and night, I have gradually acquired a deep understanding of the movements of the rice market. When all are bearish, there is cause for price to rise. When everyone is bullish, there is cause for the price to fall. He described the rotation of yang, a bullish market, and yin, a bearish market, and claims that within each type of market is an instance of the other type. This is what we call as trend and counter trend. He appears to have used weather and market volume as well as price in adopting trading positions. He is considered the most successful market trader in history. generating over 100 BN in profits as today's prices, some years earning over 10 BN a year. So he generated over 100 BN in profits at today's prices, some years earning over 10 BN a year. Okay, wow. Some sources claim he was authored 2 other books, a full commentary of the Sakaga strategy and tales of a life immersed in the market. The Japanese candlestick charts became very popular due to the travel of ease in reading and understanding the graphs. The Japanese rice traders also found that the resulting charts would provide a fairly reliable tool to predict future demand. Steve Nissen understood the startling power of the Japanese candlestick charts and popularized this method to the Western Hemisphere. He is acknowledged as the leading authority on the subject. Articles written by Steve Nissen that explain candlestick charting appeared in the December 1989 and April 1990 issue of Futures magazine. He has written a definitive book on the subject by name Japanese Candlestick Charting Techniques. That's the very first book I showed you guys, the yellow one. Controversy in Beyond Candlesticks, Nissen says, in the material I had translated, candle charts are often called Sakata charts in reference to the port city of Sakata, where Haman lived. However, based on my research, it is unlikely that Hama used candle charts. As will be seen later when I discuss the evolution of the candle charts, it was more likely that candle charts were developed in the early part of the Meiji period in Japan in the late 1800s. With this research, Steve Nissen explained the evolution of the candle charts. Number 1. Stopping chart. These are also called as point charts. Line charts are star charts. Line charts or star charts. This was the earliest type of chart and was drawn by joining only closing prices. The name came from the fact that each point or a star is where the price stopped by the end of the session. So stopping chart. Let's see what it is. This would have been a stopping chart, just like this. Number 2, pull chart. This chart added the extra information by showing the range between the high and the low of the session. These lines show not only the direction of the move, but the extent of the move for each session. Since each representation of range appears versus vertical lines, they were called as pull charts. And these were pull charts right here. This one. Number 3, bar charts. These are most common used charts in the Western world. This is a combination of the stopping charts and pull charts. They show not only the range of trading session by depicting the highs and lows, but also show open and close points, using open, high, low, and close prices. Some charts may not show open price. They only use high, low, and close prices. So bar charts. Again, these were bar charts right here. So you can see there's really not much information you can really get off of these if you were to be a day trader, somewhat of a swing trader, because you don't know what the price is really, where support and resistance is. So it had to have been fairly hard, but they adapted to what they were given, and there were people who succeeded with it. But we've come a long way. Number 4, anchor charts. These are supposed to have originated in the Kyo era from 1716. The usual meeting place for rice traders was port cities, so they might have taken a cue from anchor to create this chart. The top and bottom of the anchor's vertical line are the high and low of that session. The horizontal line of the anchor line is the open. The arrow of the anchor line is the close. If the close is higher than the open, the anchor points up, and if the close is lower, the anchor points down. Anchor chart. Right here, this is an anchor chart. So these right here are anchor charts. Number 5, candle chart. The next improvement from the anchor charts was the Japanese candlestick chart. The candles probably started in the early part of the Meiji period from 1868. Candle lines were a refinement of the anchor chart. The use of black and white real bodies made analyzing and underlining supply and demand situation visually easier to determine than with the anchor charts. With the arrival of the candle charts, Japanese technical analysis flowered as people started thinking in terms of signals and trading strategies. Patterns were developed, and market prediction became more important. Trying to forecast the market took an extra importance in the 1870s when the Japanese stock market opened. Steve Nissen opinions bar charts were one of the ancestors of the more evolved and productive Japanese candlestick charts. In essence, this means that since most of the West is still using bar charts, it is also using a less evolved form of charting than the Japanese are with the candle charts. Because candlesticks display the relationship between the open, high, low, and closing prices, they cannot be displayed on securities that only have closing prices, nor were they intended to be displayed on securities that lack opening prices. And that's it. So I hope you guys enjoyed that little story time. That's just a little back history, getting in depth of the different charts that they've used, and like I said, the history of the candlestick charts. It's good to know the back history of these candlesticks. So let's get into these candlesticks here. Now there's just a handful of them that you just have to know, and what I recommend is getting flashcards if you're brand new, writing and drawing these down, and just looking at them every day to remember them. And before you know it, you'll know what these are. There are not a lot of them, and we're just going to go over the basics of them, what you should know. So we went over the basic open, the close, the high, and the low of a candlestick. I will leave a link to this website right here down below in the description if you guys are more interested and want to look further into this. So this is chartschool.com or stockcharts.com. I will leave a description for this website in the description below. Check them out. You can learn a lot from these websites right here. Now this is a little history of it. The formation right here, it'll be displayed. We went over that already. And a couple examples right here comparing the bar chart to the candlestick chart. And this is just a basic candle right here. You have a big candle or a little short candle. Maribuza. These candlesticks have weird names. There's going to be a lot of them with weird names. You don't really technically have to memorize what the actual name is, as long as you know what the candle meaning is. Now this is a full-bodied candle here. This would be a bullish candle. This would be a bearish candle. Price opens at the bottom on a bullish candle, moves up and closes at the top. That's what forms a bullish candle. Now a bearish candle opens at the top, and as prices move down, closes at the bottom. Fill in this red or black. That's a bearish. Most candles will have these long poles right here. We call those wicks. Some candles won't have wicks. Most candles do have wicks. So these are long shadows, poles, or wicks, whatever which one you would want to call them. And they provide valuable information about the trading session. Upper shadows represent the session high, and the lower shadow represents the session low. Candlesticks with short shadows indicate that most of the trading action was confirmed near the open and close. Candlesticks with long shadows show that price extended well past the open and close. So what it's saying here is this opened right here and price moved up and then it came right back down. Whenever you see a wick on a candle, the price moved in that direction and it came right back. Spinning tops. Spinning tops are these right here. The body is right in the middle and you have an even length, upper shadow and lower shadow. And sometimes the lower shadow can be very, very long, or the upper shadow can be very, very long. So candlesticks with a long upper shadow, long lower shadow, and small real body are called spinning tops. One long shadow represents a reversal of sorts. Spinning tops represent indecision. The body, the small real body, whether hollow or filled, shows little movement from open to close, and the shadows indicate that both bulls and bears were active during the session. Even though the session opened and closed within little change, price moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand, and the result was a standoff. After a long advance or long white candle, a spinning top indicates weakness among the bulls and potential change or interruption in trend. After a long decline or long black candlestick, a spinning top indicates weakness among the bears and a potential change or interruption in trend. So what it's saying is when you see a spinning top like this, or with long upper shadows or long lower shadows, it comes right back with the small body here, that's indecision. The bulls or the bears are in indecision. They don't know if they want the price to go up. They don't know if they want the price to go down. And these usually appear at the top of charts or at the bottom of charts, or right in the middle of a chart when something's consolidating. Doji, same thing as spinning tops, but there's really no body on these charts. It's just a line. So the price opened and closed right at the same price. You got the doji here, and you got a long doji here. Ideally, but not necessarily, the open and close should be equal. White, a doji with an equal open and close would be considered more robust. It is more important to capture the essence of the candlestick. Doji convey a sense of indecision or tug of war between buyers and sellers. Prices move above and below the opening level during the session, but close at or near the opening level. The result is a standoff. Neither bulls nor bears were able to gain control, and a turning point could be developing. And these are more effective on daily charts. And again, you would normally see these at the top or bottom of charts or in the middle of charts when a stock is consolidating. And I'm just going to go over a lot of the basics with you guys. There are a lot of these candlesticks and a lot of candlestick patterns. I might do another video of a couple candlestick patterns that are most popular that you should be looking out for. And then you got long-legged dojis. So you got long-legged dojis, you got dojis, and you got spinning tops, and you got dragonfly and gravestone dojis. These are all the same thing, but they just look different. Prices open up move one way, go the other way, close at the same price it opened at, or near the same price. Or a dragonfly doji, prices open, go way down, come right back up and close where it opened. Dragonfly dojis you normally see at the bottom of charts. Gravestone dojis you find at the top of charts, because price went up and got rejected at a higher level and came back down. Prices on a lower chart go lower, come right back up and closes because prices got rejected lower. So these normally indicate trend reversals. They don't work all the time, but it's indicating to you a reversal may be near. So dragonfly and gravestone dojis, long-legged dojis, you got just dojis and spinning tops. They're all the same meaning, but they're all just look different. So we have bulls versus bears. A candlestick depicts the battle between bulls, buyers, and bears, sellers, over a given period of time. An analogy of this battle can be made between two football teams, which we can also call the bulls and the bears. The bottom intra-session low of the candlestick represents a touchdown for the bears, and the top intra-session high a touchdown for the bulls. The closer the close is to the high, the closer the bulls are to a touchdown. The closer the close is to the low, the close of the bears are to a touchdown. While there are many variations, I have narrowed the field to 6 types of games or candlesticks. Number 1. A long white candlestick indicates that the bulls controlled the ball trading for most of the game. So that's this one right here. That is a very bullish candle. Prices opened up down here, moved up and up and up and up and up and up, and closed very high up here. Number 2, long black candlestick indicates that the bears controlled the ball, trading for most of the game. Prices opened here at the top, and it fell, and closed down here. Number 3, small candlesticks indicate that neither team could move the ball, and prices finished about where they started. That's this right here. That's a bearish, that's a bullish. But the price range was very, very small, so it could be considered a doji. Number 4, a long lower shadow indicates that the bears controlled the ball for part of the game, but lost control by the end, and the bulls made an impressive comeback. And that's this right here. Price opens at the bottom, moves up, or price opens here and moves down, but then comes right back up, crosses over where it opened. Now it's green on the day, and closes up here. Or prices open up right here at the top and fall, and then come right back up and closes right here. Number 5, a long upper shadow indicates that the bulls controlled the ball for part of the game, but lost control by the end, and the bears made an impressive comeback. This is the same analogy for this one right here. Number 6, a long upper and lower shadow indicates that both the bears and the bulls had their moments during the game, but neither could put the other away, resulting in a standoff. And this is a spinning top right here. What candlesticks don't tell you. Candlesticks do not reflect the sequence of events between the open and close, only the relationship between the open and the close. The high and the low are obvious and indisputable, but candlesticks and bar charts cannot tell us which came first. With a long white candlestick, the assumption is that prices advanced most of the session. However, based on the high-low sequence, the session could have been more volatile. The example above depicts two possible high-low sequences that would form the same candlestick. The first sequence shows two small moves. The one large move, a small decline off the open to form the low, a sharp advance to form the high, and a small decline to form the close. The second sequence shows three rather sharp moves. A sharp advance off the open to form a high, a sharp decline to form the low, and a sharp advance to form the close. The first sequence portrays strong, sustained buying pressure and would be considered more bullish. The second sequence reflects more volatility and some selling pressure. These are just two examples, and there are hundreds of potential combinations that could result in the same candlestick. Candlesticks still offer valuable information on the relative positions of the open, high, low, and close. However, the trading activity that forms a particular candlestick can vary. What it's pretty much telling us is you have the candlestick right here, but it doesn't display what happens in this body. That's why it's always good to have multiple charts to see a chart intraday. So you would have this be the daily chart, and then you would have a 1-minute chart, a 5-minute chart, a 10-minute or a 15-minute, a 30-minute, and a 1-hour chart to get an idea of what price is doing in this body on the daily chart. Where is it finding support? Where is it having resistance? To better get an understanding of what's happening inside the daily chart. That pretty much sums up this website. That's all I'm going to get into on this one. I just wanted to get in the very, very basics of the candlesticks and the history of candlesticks. I will do another video explaining candlestick patterns and formations because there are a few of them. There are actually a lot of candlestick patterns, but there are only a few that you have to remember that happen over and over and over again, that all traders know and that all traders look for, and they happen over and over and over again. And I will be going over and explaining that in the next video. Like I said before, I will leave the description to this website, stockcharts.com, and I will be leaving a link to this website. I really didn't go into depth too much of this website, but this website gives a whole lot of information to you guys, and I have another video where I tell you guys about this website, and it's just jam-packed, filled with stuff from quizzes, psychology, patterns, Elliott wave, fundamentals, all kinds of stuff. And same thing with stockcharts.com. You just go to the chart school right here, and they have all of this stuff for you guys to learn from. I hope this video was educational and you guys learned a lot from it. Hit that like button if I did a good job, and hit that subscribe button. Alright guys, later.